The Fed's March meeting went exactly as expected until investors looked at the new projections. With inflation estimates rising, GDP growth slowing, and uncertainty increasing, what does this mean for future rate cuts? We break it all down, and at the end, we'll reveal the key economic report next week that could change everything. Stay tuned.
Thing number 3, we're talking the March Fed meeting, FOMC, the Federal Open Market Committee. No one was too surprised until, Gary, you say the investors saw some change in the projections. So thing number 3, Gary, March FOMC meeting went as expected, except the projections. Tell us what we need to know.
Well, so the Federal Reserve kept the Fed funds rate steady. That surprised exactly no one. And they maintained their forecast for 2 rate cuts in 2025. Also surprised nobody. That decision came with ongoing uncertainty about the economy. And, in fact, the Federal Reserve put language talking about increased uncertainty in the press release. And Jerome Powell, the chairman, during his press conference, actually talked about the difficulty of assessing inflation driven by tariffs, adding complexity. He talked about potential unexpected weakening in the labor market, and again, uncertainty. He talked about it constantly. So, one of the things that we saw, while people were not surprised by the fact that the Fed kept rates unchanged, they changed their projections, and not in a good way. The inflation projection increased from 2.5% to 2.7%. GDP growth expectation, declined from 2.1 to 1.7%. Expected unemployment rate was raised from 4.3 to 4.4. So, what we saw was government expectations were for more inflation, less growth, more unemployment. The only thing I would add on all of that is that if the lower GDP and higher unemployment is due to a reduction in government waste, that actually would be a net benefit to the economy, even though it will make the aggregate numbers look weaker.
Gary, I know you said that there was no real surprise in the decision to pause. That was expected by you and everyone at DKI. Were there any changes, surprises that you did find in any of the communications from the Fed?
There were a few. One, and I can't believe I'm about to say this, Chairman Powell pulled out the T word. During his press conference, he described tariff-related inflation as transitory. For those of you who are a little newer to the story, Powell and then Treasury Secretary Janet Yellen were describing inflation as transitory in late 2020, early 2021. Late 21, early 22. They clearly were wrong. It is still a problem now, 3+ years later. Inflation has really been a problem for 3.5 years. So 3.5 years ago, they were saying it's transitory. In the meantime, I can't believe I'm saying this, but I agree with him. If we get tariff-related inflation, and we might or we might not, but if we do, it actually will be transitory. It would be a one-time bump rather than a constant increase. So somehow I agree with him on that. Beyond that, there was a little bit of a change in the dot plot. That is just the chart where each member of the Federal Reserve, each Fed governor, puts a dot where they expect the Fed funds rate to be this year, next year, the year after, and long term. So I told you before that the expectation is for 2 rate cuts in 2025. That's still the case, but the outliers went from evenly distributed above and below that level to the outliers are now solidly above the line. And what that means is that the Fed is becoming gradually slightly more hawkish. Hawkish means favoring higher interest rates. So that was a bit of a change. And then, beyond that, the big news from the press release was language talking about increased future uncertainty for the economy. And then the final thing is the Fed reduced their quantitative tightening. So again, just a fancy way of saying in order to provide liquidity to the system and keep, people spending in the economy during COVID, what they did was they ran up a gigantic $9 trillion balance sheet. Again, just a fancy way of saying providing lots of liquidity into the market. Now, over the last couple of years, they've been reducing it, and they've taken somewhere in the neighborhood of almost $2 trillion out of that Fed balance sheet. Now, the Fed balance sheet is still enormous. It's still $7 trillion. But what they're doing is they're reducing the amount of quantitative tightening, or the rate at which they're pulling stimulus out of the economy. They're being more cautious about reducing that balance sheet, meaning they're more worried right now about the state of the economy than they are about inflation.